In the last 36 hours, something happened in the precious metals market that almost nobody truly understands. Prices collapsed, headlines screamed panic, trillions of dollars vanished in a very short window of time. And yet, while most people were focused on price alone, the most important signals in the market were quietly moving in the opposite direction. More than $7 trillion in value was erased from precious metals in a matter of hours. Silver dropped roughly 30%. Gold fell more than 13%. Platinum and palladium were hit even harder. On the surface, this looks like failure. It looks like a market breaking down. It looks like confidence evaporating. It looks like the end of a cycle. But price alone doesn't tell you what's really happening. Price is only one layer of the market, and during periods of stress, it's often the noisiest layer. Silver briefly fell below $85, erasing nearly $2 trillion in market value almost instantly. Gold slipped under $4,900. For silver, this was the most severe decline since 1921. More than a century of market history and compressed into hours. Moves like that come from pressure. Here's the part most people completely missed. Before prices collapsed, physical demand surged. On the first notice day for February silver contracts, nearly 10 million ounces were registered for delivery, and this happened before the sell-off began. That detail matters, because in a genuinely weak market, delivery demand disappears first. Buyers step back. Inventory builds. That's not what happened here. Instead, demand showed up early, and in size. At the same time, major banks weren't exiting the market. They were actively repositioning inside it. Wells Fargo issued more than 7,000 delivery notices. JP Morgan both issued and stopped hundreds of contracts. Macquarie did the same. Issuing and stopping simultaneously is not passive behavior. It's active management under stress. That kind of behavior signals internal strain, not a loss of interest in the underlying asset. And this wasn't happening in isolation. When you include simultaneous losses in U.S. equity markets, more than $10 trillion in global market value disappeared in under 2 days. That scale matters, because markets do not reprice fundamentals that quickly. They liquidate positions that quickly. This wasn't a careful reassessment of value. It was forced selling. Now here's where the story really breaks away from the headlines. Silver fell almost 35% intraday, the largest such move ever recorded. And yet, despite that historic collapse, silver still closed the month up 19%. 9 consecutive positive months. That combination is extremely rare. Violent short-term stress without a full trend reversal. That's the signature of a liquidity event, not long-term demand destruction. And then there's the physical market, the part of the system that moves slower, but tells the truth more clearly. While U.S. futures closed near $85, physical silver in Shanghai traded around $122, a $37 premium, more than 43% above paper prices. In a real breakdown, premiums collapse. Sellers rush to unload metal. This time, none of that happened. The premium held. That tells us the physical market was not following the paper market down. It was operating on a different signal, one driven by availability, delivery, and real demand. Depending on how you were positioned, this move felt completely different. If you were leveraged, it was brutal. Margin calls don't care about narratives. They force liquidation mechanically. If you were long physical, the message was more complex. Technically, the damage is real, but fundamentals don't reset in 36 hours. Nothing structural changed. What did change was liquidity. This was a paper market reset, not a collapse in physical demand. Add to that a growing probability of a U.S. government shutdown, historically a trigger for liquidation first and policy response later, and the timing begins to make sense. So here's the key takeaway. When paper prices collapse while physical premiums hold, the market is not signaling weakness, it's signaling tension. And tension is what builds the next move.